Markets are taking another tanking following worse than expected jobs numbers out of the US on Friday, as well as warnings from Hungary that it could face a debt crisis similar to Greece's. So are the risks building, and is the global recovery still intact? That's what we're asking Chris Hart, investment strategist at Investment Solutions. Chris, thanks for coming in this afternoon.
Pleasure.
Chris, Hungary putting the shock through the markets on Friday. How much attention should we be paying to Hungary? It is a small economy. It's not part of the European Monetary Union. Is it a potential risk?
If it was just Hungary, you could say, okay, it's easy to fix up, just give the IMF a call and sort of fix it up. By the weekend, it's over. The only trouble is it's Greece and Hungary and Ukraine and Iceland and you go to Spain, Portugal, Italy, Greece, UK, etc. The point is that there's no shortages of countries that are in that thing. And this is, I think, over a decade where I think too much emphasis is paid on the contribution a government would make to the economy. You know, if you say, right, how do you work out an economy? It's agriculture plus mining plus manufacturing plus government plus exports minus imports, that kind of thing. And not enough emphasis is placed to actually say, well, what do these activities do? And governments consume wealth, and things like manufacturing, mining, etc., create wealth. Now, it's not to say one's wrong and one's right, but obviously there's got to be a decent proportion. And you cannot have governments coming in and their contribution, as it were, is 52% or of spending, with a deficit of in excess of 10%. You say, what actually is supporting, what's creating the wealth to sustain that kind of activity? And that's the problem, is that there is the weight of government on too much debt and too little wealth production to service it. That's to my mind, it's quite a simple thing if one actually wanted to boil it down to that.
And it appears to be rife.
And it's rife. Unfortunately, electorates are demanding governments do more, not less. And this is a time when you actually need to say, whoa, we actually have overstretched ourselves. We need to start doing less. And so more regulation, in other words, it makes it more difficult to create wealth with higher taxes. So wealth that you do create is taken away from you quite quickly. But to actually do it, you've got to go through these layers of bureaucracy, etc. It's not looking good.
And of course, Hungary is one of those emerging markets they always talk about with South Africa, with Turkey. So they'll say, oh, well, the rand's done so-and-so, the lira's done so-and-so, the forint in Hungary has done whatever. Now, our debt problem is not nearly as bad as Hungary's. Do you think at some point investors will become a bit more discerning, will look past the crisis we're seeing at the moment and say, well, hey, South Africa's not looking too bad, let's invest there?
I would go so far as to say, we don't have a debt problem. Hungary does. Okay, it's not that ours isn't as bad as theirs.
It's not a problem.
It's
manageable.
It's nowhere near a problem. Okay, but the current trend, it'll get to a problem. So obviously we're on the wrong path, but we're still at the early stages. We're a country that still can make choices. Hungary, the choices are all bad. Greece, it's all bad. You know, the best that they can actually hope for is to muddle through, and that looks increasingly not possible. So we need to be careful, and I think this kind of world actually gives countries like South Africa, which still has good choices we can make, a wonderful opportunity. You've got the UK, for instance, that wants to score an own goal. They've just bailed their banking system out. They want to impose an extra tax. It's not to say that they're going to impose this tax on the mining sector, and the revenue that they get will be compensated by, say, maybe cutting another tax somewhere else. It's just an expansion of a government that's already taking more than 52% of the economy. And that's, to my mind, scoring an own goal. London is a core financial centre. Is this not an opportunity to say South Africa actually is a really friendly operation, that the banks are not seen as the enemy, they're part of the economy? Come and have an easier thing. It's not to say that we shouldn't have regulations, but they must be more pragmatic and more practical, etc. Not just to actually be, treat the industry as an enemy. And that's the problem. So these are opportunities for South Africa, as long as we just don't sink in and line up and say, okay, if you're imposing a tax, we'll also, etc., etc. fortunately, we're resisting it, and that's, I think, a good thing.
Well, the prospects in Europe look pretty bleak at the moment. Yes. We had PMI numbers out of China at the beginning of last week that shows that their recovery is starting to level off a little bit. It's not growing as it was a little bit earlier. And of course, we had the jobs data out of the United States on Friday, which shows it's still a jobless recovery. Jobs aren't being created at any fast rate in the United States. Where do we stand with this global recovery at the moment? Is it still intact?
It's intact but running out of steam, which is a bit of a pity. You'd expect more of a recovery for a few, for a few $1 trillion than what we're getting at the moment. And I think that's again the problem, is that capital is being destroyed because interest rates are too low. So you get very poor allocation of capital because you don't have an opportunity cost for that capital, and it tends to be borrowed now. So where we need to go is that if capital is being allocated badly, it's not having the right multiplier effects, to actually sustain the recovery, and that's why it might be fizzling out at this point. In countries like Brazil and South Africa, where there is a reasonable opportunity cost for capital, I think capital is allocated a bit better, and we've got it's on the right side of the recovery. We're coming from high to low. And that helps to spur the recovery, although I think we still need to see in South Africa a few of the factors that you would be looking at. For instance, the interest rate effect has a lag to it. The credit still has to change from a tailwind to or a headwind to a tailwind to the economy. These things actually start to realign after the World Cup. The World Cup is almost a distraction, but the World Cup does provide some expenditure injection, which will provide some multipliers that will help to actually boost the recovery in the second half of the year. Unfortunately, it might be running into a faltering recovery offshore, which is a bit of a pity. So the offshore might not help reinforce our own recovery.
Chris, we have to leave there. Thank you very much for coming in.